Hello, this is Nick Rach. Going to provide you an earnings update here in third quarter earnings season of the most important thing, the fourth quarter 2016 guidance that's changing as companies report their third quarter numbers. But let's take a quick look at the third quarter scorecard to find out where we stack up here. We have 116 companies in the S&P 500 have reported through Friday, October 21st. And what we see is 80% of those companies are beating their lowered earnings per share estimates. Average earnings growth 8.1%. You can see all the sectors here. That's third quarter 16 earnings growth versus third quarter 15 earnings growth. So pretty solid numbers on the bottom line. How does that stack up? We've been saying growth is going to reaccelerate in 2016, at least for the first 116 on the clock. Take a look. Their third quarter year-over-year earnings growth, 8.1%. How did these same companies do in the second quarter? Last quarter, they only had 4.5% earnings growth. And their sales growth wasn't even as solid, and less companies were beating estimates both on the top and bottom lines. We've been saying the first quarter earnings season is going to mark the low water mark for growth in 2016. So far, that's been the case for these early reporters, and we think these 116 are going to be a reflection of how the rest of the companies report. When overall the 500 companies in the S&P come in, we expect to see this reacceleration of growth that we're seeing with these companies. We do want to highlight a difference between this year and last year, though. Last year at this time, we were measuring the rates of growth decelerating in 2015, and certainly the first 116 companies on the clock, you could see how their numbers were also deteriorating, their rates of growth last year in 2015. In 2016, what we're seeing is modest reacceleration of growth, something, the trend that we think is going to persist into the first half of 2017 based on the current expectations and the revision trends that we're going to show you. Because while we showed you the third quarter scorecards, this scorecard, the fourth quarter 2016 earnings guidance scorecard, is what really matters in third quarter earnings season. So it's not whether a company beats its estimates. What matters is the direction of its estimates that changes take place after the company's report. And what we see here is while 80% of companies are beating their third quarter earnings estimates, only 31% of companies after they report are seeing fourth quarter estimates, their next quarter estimate, go up after they report. And in aggregate, these 116 companies are seeing their estimates fall by about minus 0.5%. So throughout 2016, what we've seen here is fourth quarter estimates going lower throughout the year. Now, a lot of people think that the market has become disconnected from earnings because prices have been rising as earnings estimates fall. What we say is it doesn't matter that earnings estimates are going down and going lower. It's about the direction. So what we want to see is, how do these estimates of where they're being cut right now at a rate of minus 0.5% stack up to prior periods? And if you look last earnings season, third quarter 16 estimates were being cut by a rate of 1.59%. In first quarter earnings season, second quarter estimates were being cut by a rate of minus 2.08%. So less negative revisions. And to show you where the estimates are coming down, and we're only showing here on the screen back to the fourth quarter of 2013, but if we went back further, 22 quarters, all these bars would be red in that net estimate revisions are negative for the S&P 500 after companies report for the majority of companies. But take a look at this. In 2014, when the estimate trends were getting better, i.e. getting cut at lesser rates, stock prices went higher. And when stock prices struggled in 2015, it was because estimates were falling at increasing rates. They were weakening. And when the market bottomed in February of this year, what we've seen is earnings expectations improve again. Yes, the estimates are getting cut. They're not getting cut nearly as bad today as they were in second quarter earnings season, or in first quarter earnings season, or in fourth quarter earnings season, where we saw those first quarter estimates getting cut at a rate of minus 4.3%. Now, we have 180 more companies reporting this week. So in other words, it's taken us about a month and a half to get 116 on the clock. We're going to get 180 more just this week. So it's going to be a very busy earnings season. And what we're going to be looking is for the direction of the earnings estimates changes that occurs after these companies report. And mind you, Once we get these 180 on the clock combined with the 116, we're going to have a vast majority of the companies in. The trend will be set. So we've been very pleasantly surprised how well the fourth quarter estimates are holding up here, because we think those expectations for the fourth quarter of 16 and the first quarter of 17 for the S&P 500 earnings growth, those expectations are pretty high, and remarkably they're holding up here. So that says to us that growth is going to continue to accelerate into the fourth quarter and into the first half of 2017. Now, if there's any deterioration in the earnings estimate trends, we will be measuring and analyzing that data this week, and we'll be the first to tell you. So if you want to learn more, not just on the macro picture of what we're seeing on earnings here, but if you want to see custom portfolio analysis or any sector, industry, or company analysis on their earnings estimate trends and what is or isn't factored into the price based on those earnings trends, contact our sales and marketing team on the screen here, or you can give us a contact also at sales@earningsscout.com. Thank you for listening, and have a good week trading this week. Thank you. Bye.